Hello and welcome to your 2019 second quarter commentary video. We're going to take you through a couple different topics, one being the market. We're also going to look at housing as well as yield curve analysis, and we're going to talk about how to best navigate the markets if you are in the market. And we're also going to revisit bonds. So let's talk about the market real quick. Last year, we ended the market with what's called a sell signal, also called a death cross. And that's when the 50-day moving average crosses through the 200-day moving average of the market. That usually means get out, right? We saw a recovery of the markets, and then which led to a buy signal in late April. That usually means that you can transition back into risk from a technical indicator. And then we've really seen the markets range bound and volatile. There hasn't been much increase to the market actually in the last 12 months. We've just seen it trading within a range. Now, most of that is due to global growth concerns relating to tariffs, right? And that's actually intensified, giving the market pause for concern, which sent the markets into very volatile territory. A glimmer of hope, though, has been one, the tariffs being potentially resolved at some point. Two, the Fed. The Fed uh, has had a change in attitude, and the attitude change is really is that it's signaled it's going to help the economy rather than kind of work against it by rising rates, alluding to potential interest rate decreases in the future if need be. So that's been one of the positive signals that have come out on the markets, and what's kind of trended the market forward in the last couple of weeks. Let's look at housing real quick because it's been a great indicator for recessions in the past. Notice recessions in gray bars back in the 90s, 2000s, and 2008, and housing really peaking, dropping, several years actually before recessions began. As of now, we've seen housing start to show signs of cooling off, right? However, there's no major reduction in housing, which leads us to believe that there's no grave cause for concern in what we're seeing in terms of housing data. Something that we're still watching, though. Yield curve analysis, though, is what's been getting a little bit more attention. And this is a closely watched metric because it's really tipped off some recessions in the past. In fact, the yield curve has predicted the last 7 recessions that we've had. And what we're looking at really is the 10-year and 2-year treasury yield. If the 10-year treasury yield is above that red line, then it's paying more than the 2-year. But every once in a while, it will dip below that red line, which signifies that the yield curve has inverted, that the 2-year is now paying more than the 10-year. Right now, we still remain in positive territory with about a 0.16 spread between the 10-year and 2-year treasury. While this may seem concerning, it should be noted that once an inversion has taken place, there's been an average of 16 months until a recession has begun. During the months, or in some case, even years prior to an inversion or shortly after inverting, there's been good performing periods of the market. So pulling out of the market prior to inverting would be pretty premature, and it could be harmful to long-term investment goals if you did that. So right now we're kind of in a cautious wait and see pattern, but we're not in a let's get out, let's panic. We're getting close to inverting. No, that's not how this should be looked at. Okay. So let's say we're starting to get a little bit more volatility in the markets, which we've had, and let's say that that's probably going to continue for a little bit. What should investors do during late stages of the bull market run, which is what we're in, when volatility is going to be the norm? Well, rather than pulling out of stock indexes altogether, we should look at stock indexes that are potentially lower volatile than the broader stock market index shown in yellow, which is the S&P 500. Notice the big dip that the S&P 500 had at the end of last year. Notice the dips that the MSCI minimum volatility US index had in comparison, as well as the high yield dividend aristocrats dividend index had. Much less of a drop off and a far better recovery. So we're going to recommend that rather than replace equities with lower risk investments like, let's say, bonds, we still like the market. We, however, think that navigating the market within low volatility options as well as dividend options is a better play. However, we understand that some folks are more risk adverse than others. And bonds have been, for the last 20 years, an excellent place for conservative investors to sit their money in and preserve their capital and receive income. However, the last 2 to 3 year period has been very bad for bonds. Interest rates were being risen by the Fed, and what was causing actually bond values to go down. That's what happens when interest rates go up. Bonds actually are hurt by that. So the last time we saw the Fed raise interest rates was in December of 2018. Since then, we've seen a major recovery to bonds. So what that tells us is, with this uncertainty in the economy, with the fact that the Fed has now mentioned we're no longer going to work against the economy, we're no longer going to work against the bond market, we're going to actually either lower interest rates if need be, or at least keep them where they're at. That's sent a very positive image and has helped the bond market considerably. So we now have adjusted our future outlook on bonds to more favorable. And one could look to bonds for a stable income as well as capital preservation, rather than look to things potentially like fixed annuities or things that provide income in a more product level where you're making a commitment for a certain amount of time. So we now like bonds as a good replacement for your conservative stuff, and should be a useful asset class in managing risk moving forward, as opposed to a couple last years was really tough pickings from the bond market. So to recap everything, we still remain in an uncertain economic outlook where every week there's a different news headline that comes out, whether it's tariffs, whether it's a deal that's going to be happening with the Chinese, whether it's not. We're going to remain in a volatile market. So again, rather than use broader base indexes that carry like the S&P 500 that carry weightings to highly speculative companies like tech companies or highly valued in terms of price to earnings ratio companies, let's look towards a lower volatility in companies. Let's look towards the dividend producing companies. Those will all come in different index and ETS funds that we've mentioned to you guys in your reviews. Investors looking for conservative options can now look to bonds. So again, we mentioned that in the bond recap. That is back on the table, and I think I'm very confident the bonds will be a good place for investors for the next 2 to 3 year period. Again, we'll continue to monitor your portfolios. We'll send you timely updates as you need them. And those clients who have not talked to us about setting up in discretion on your accounts to make timely adjustments without approval or pre-approval, we urge you to reach out to us. Let's have the conversation about discretion. It is a useful tool in navigating the markets and enhancing the servicing that we can do on your portfolios. As always, if you have any questions, concerns, or comments about your portfolio, we welcome them. Please feel free, reach out, talk to me, myself, or David. be happy to talk with you, meet with you on your portfolio. We hope your summer's off to a great start. We thank you for your business and your trust, and I hope you have a great summer. Take care, guys. Talk to you soon.